I think the biggest problem facing the United States will be the fact that the inflation genie won't be back in the bottle, and people will continue to complain about affordability. And by the way, Trump has very low ratings on the economy, on the economic performance of the U.S. economy. He has very low ratings. And you've got midterm elections coming up. And if this continues, and if my thinking is correct that inflation genie will not be put back in the bottle, I think the Republicans will have a lot of trouble in the midterms. So that and because affordability will stay on everybody's radar. It's something that is associated with not being able to put the inflation genie back in the bottle. So,
hey everyone, my name is Anthony Fatsis and welcome to another episode of the What the Finance podcast. On this episode, I have the pleasure of welcoming back Steve Hanke. So Steve is a renowned economist, the professor of applied economics and founder and co-director of the Institute for Applied Economics, Global Health and Study of Business Enterprise at the Johns Hopkins University. And he's also the author of many, many books. So Professor Hanke, thanks so much for coming back on the podcast and Happy New Year.
Happy New Year to you. And thanks for having me, Anthony. Good to be with you.
No problem at all. Yeah, I'm really looking forward to the conversation. And I thought we'd start sort of with the breaking news over the weekend. The DOJ has come out and sort of accused the Fed of fraudulent activity with the creation, the building of their new headquarters. But yeah, I'd be really interested in hearing, is this unprecedented? How are you looking at it?
Well, the threats from the White House, the president, against Chairman Powell have been pretty constant, but this, which is somewhat unusual, but it really is unprecedented. I mean, threatening to bring criminal charges against the chairman of the Fed, it's starting to take on kind of a third world odor. I mean, you see this kind of stuff in third world countries, but you don't see it. The big boys don't play like this.
Yeah, and it does seem that it's a weird timing to do it as well. 5 weeks before he's sort of meant to leave, or or there's meant to be finding out when who the new chairperson is going to be. So it does seem quite weird.
Yeah, it's really, as they say, it really is beyond the pale. There's no question about it. But right away, almost instantly, Powell did make I think a proper statement. He said what he had to say. In short, the threat wasn't rattling his cage at all, and everything was in order. And it's clear it's a frivolous threat in a way. I'm certain that the Fed, with regard to the remodeling and work that's being done at the Fed, is everything. The Fed runs things by the book. So unlike most government bureaus and agencies, the Fed is independent, and it does run things pretty much by the book. So it's whether you agree with their policy or not. I've been highly critical of Powell and highly critical of the Fed because they have abandoned the quantity theory of money and basically monetarism. The position of Powell in testimony has been that the changes in the money supply don't have any reliable connection with changes in economic activity, which is just nonsense. So I've been critical since day one, and certainly since 2020, when the Fed stepped on the accelerator and increased the money supply to record rates of increase, by the way, since the Fed had been founded in 1913. We had the highest acceleration in the growth rate in the money supply we've ever realized. And of course, with a short lag, boom, we ended up with inflation zooming up to 9.1%. And if you use the quantity theory of money, which I do, and John Greenwood, one of my colleagues, does. We said at that time, given the increase in the money supply, that the inflation rate would go up to as high as 9%. Well, it went up to 9.1%. And then they slammed on the brakes and reversed everything and squeezed the money supply, and inflation started coming down. And now it looks to me like they're pivoting again, because in December, the Fed dropped quantitative tightening and indicated that it was going to buy $40 billion of T-bills in a quantitative easing kind of move. And the Fed funds rates are coming down. And we've had bank deregulation with the supplementary liquidity ratio. That will be coming off in April. So that when that happens, the banks will have more reserves and more ammunition to deal out more loans, and that will increase the money supply. So all the money supply, shall we say, tenor looks like it's for more loosening of the money supply. And this will mean, of course, that the genie of inflation hasn't really been completely put back in the bottle yet, and it looks like it's going to get worse. So this year, I think the big news will be that the Fed has not been able to put inflation back in the bottle. And of course, this will give Trump a big headache, because he's been demanding that they loosen the money supply. That's what all this threat is all about. If you want to get down to the bottom line, he wants looser monetary policy. That is, Trump wants looser monetary policy. And he talks about it always in terms of narrowly, not the money supply or anything like that, but just keep the Fed funds rate low. And we have a big fiscal deficit in the United States, and it looks like the Fed is tiptoeing back into that notion of monetizing the deficit, which, remember, in 2020, 2021, we had a huge deficit with the shutdown of the economy over COVID, the COVID lockdowns, and over 90% of that deficit was actually monetized by the Fed, and that's why the money supply increased so much. Now, this time, they stopped quantitative tightening, and they said they're going to buy $40 billion in T-bills. Well, T-bills are what's financing a big chunk of the deficit. Almost 20%, I think over 20% of the Treasury issues now are in T-bills, and those Treasury issues, that's what is financing the deficit, and who's buying now a big chunk of the T-bills? The Fed, and that means what? The Fed's monetizing those T-bills, and that increases the money supply, the rate of growth in the money supply. So that's pretty much it on the Fed. I mean, we know with the history, it's a roller coaster. The COVID came, acceleration of the money supply, inflation went up. Then they slammed on the brakes. It starts coming down. We had quantitative tightening, and it comes down. And now up. It looks like it's going up again. The growth rate in the money supply, and inflation will eventually, with a lag, go up. But in the meantime, I don't think the inflation genie will be put back in the bottle, and we'll get the headline consumer price index coming down to the target of 2%. It's running about 2.7 now, the last reading, and I just don't think, I think it's going to be going up, not down.
Yeah. So do you see the inflation being as bad as in during COVID? Because it sounds like the money supply is growing at a slower rate.
Well, right now it's hard to, my point is that the inflation genie just won't go back in the bottle, and it's probably going to get worse. How much worse, I don't know, because we don't really have enough data on the money supply acceleration we don't know how fast it's going to accelerate. We have to wait. I don't know how fast it's going to go up. I don't think it will continue to go down. It's been kind of flatline for about 6 months, and I don't think its downward trajectory will. I don't think that will occur. That's my point. So we're in kind of a pivot in terms of monetary policy. We're pivoting from tight to loose, and how loose we get, I don't know. We don't know yet. So it's hard to make any kind of analysis about how high things are going to go. That was pretty easy to do after COVID, and we saw the peak in the money supply growth, and from that we could decipher using the quantity theory of money pretty easily where things were going. Everybody had it all wrong but Greenwood and me. As far as I know, we were the only ones who had it right on.
Yeah, okay, makes sense. So if we go back to 2025, how would you review it economically? Do you think it was a successful year? Do you think it was sort of the US and the global economy underperformed? How do you look at it?
Well, it was a year of tremendous global uncertainty and kind of, shall we say, a so-so performance in terms of the real economy. Inflation was the real economy was slowing down across the globe. Inflation was slowing down across the globe. So on the one hand, you get a minus sign for the real growth in the economy, and you have to give a plus for what was going on with inflation. In the labor market in the United States, looking at the labor market and the United States, it was really a sluggish year. It didn't add. About 500,000 new jobs were added, which is a rather slow pace, actually. So that was due to the tremendous amount of regime uncertainty that's been created by the Trump administration's economic policies. They're trying to change everything at once, so there's a lot of uncertainty about what's going to happen. And on the global scene, the uncertainty there was also largely created by the Trump administration with tariff policies. So that's 2025. The good news part of it, a lot of the equity markets were roaring away. All of this didn't bother the equity markets at all. They were strong. Some of the commodities also looked very good. The precious metals, you had platinum up, hitting new highs, gold hitting new highs, silver hitting new highs, copper hitting new highs. So, speaking my own book, by the way, we're talking now on January 12th, and what did we have on January 12th? Gold hit a new all-time high. Silver hit a new all-time high. So, yeah, pardon me for talking my own book, but it's been a good day. Plus, a company that trades on the Amsterdam Exchange, the advanced metal, AMG Critical Materials, hit a 52-week high. So for me, it's just, been a great day. A happy new year.
Yeah, and as you're saying, it's been a happy new year for many people because equity markets, they had an amazing year in 2025, and it seems like that's going to continue into 2026.
Yeah, so the thing about that's interesting in my view is that as I measure the market in New York, which of course is the big elephant in the room, it's definitely in a bubble. Any way you want to measure it, I use my own bubble detector called Dr. X's bubble detector. It's been in a bubble for some time, and the thing is it's hard to predict when bubbles will pop or whether they'll slowly dissipate, come back to kind of normal levels. But we do know one thing: the popping usually occurs when monetary policy pivots into a tightening mode. And I just said at the start of our interview, we look like we're pivoting into loosening mode. So maybe the bubble just keep expanding. It doesn't look like right now the traditional popping mechanism is a tightening in monetary policy. That's one thing we know for sure about bubbles. But the rest we don't know very much about. And if you take the monetary factor out of the picture, we're kind of lost with regard to timing of popping or dissipation of an elevated and inflated bubble.
Yeah, as you say, it does seem like there's a blow off top in the US markets currently. And I guess in a lot of markets globally, they seem to have performed very well. As you said, precious metals has done very well. It does seem that bonds and the dollar are where the risk is at the moment, and probably what is going down in value.
Well, yeah, I think you're probably right on the bond market in the U.S. Anyway. As far as the dollar, I think it probably will tend towards the weak side. But remember, it's very strong. It's still very strong, even though it lost value against the major, the most important price in the world is what? The dollar-euro exchange rate. And I think the fair value for that rate is between 120 and 140. And it's still trading the U.S. on the very strong side at about 117. It's sliding towards the my fair value range of 120, 140, but it still isn't in the range yet. It's off on the high side still. So I think it will slide probably into that range this year. A little more weakness. And gold, by the way, one thing I did mention, obviously talking my own book, I long gold for a long time. Silver not quite as long as gold, and AMG credit also long for quite some. At any rate, gold that some pretty hard. And said, well, where do you think the secular bull is going to end? And I said, I think probably around $6,000 an ounce. So that has a ways to go. And the only other thing on this January 12th of 2026 that's, kind of making my day in a way is that I'm the only one in the world that is accurately measuring inflation in Iran and Venezuela, two very important countries. In Venezuela, today I measured the inflation rate at 836% per year. That's the world's highest. In Iran, it's high, but quite a bit lower. It's 84.6% in Iran. So we've had these protests going on for a couple of weeks, and the surprising thing is that the inflation is and the real have been kind of stable at the, haven't moved very much. And what happened with the capture of or kidnapping or arrest, whatever you want to call it, of Maduro in Venezuela, when that occurred, actually the bolivar lost some more value, and the inflation kind of peaked up. It was over 1,000%, and it's kind of drifted down and stabilized, as I say today, 836%. That's the world's highest inflation rate.
Yeah, wow. I guess it shows that when inflation gets very high is when you get volatility in countries and protests against especially these regimes.
Oh, absolutely. But the thing that's interesting is, for me anyway, the Iranian protest started because of the depreciation of the real and the high inflation inflation rates. And since the protests have started, things have been more or less stable at the high level, of course, and with a lot of depreciation. But there hasn't been a dramatic decline in the real and a dramatic pop up in inflation since the protests started. Things have in that sense, been surprisingly stable.
Yeah, okay, super interesting. And Venezuela, obviously, it's a big news. The, as you said, kidnap of the president. Do you see there being a regime change there, and how do you think economically it will do? Because it seems like Trump's trying to force these oil companies to invest billions into the country to increase production.
Well, the oil companies have pretty much said it's uninvestable. So that's their take on the thing. As far as where it's going, the regime hasn't been changed. Maduro's been taken out, but the regime it's exactly the same personalities that were there when Maduro was there. They're all Chavistas. So there hasn't been a regime change. And the only thing they can do in these situations, they have to smash inflation. If you have the world's highest inflation at 836%, you've got to smash it to be able to establish any kind of stability. And stability might not be everything, but everything is nothing without stability. So you have to do a big currency reform, like I've done many times to smash inflation. Either you have to have a dollar-based currency board where you'd issue the bolivar and it would be fully backed by U.S. dollar reserves and traded at a fixed exchange rate with the U.S. dollar. That's one way, which actually, when I was President Caldera's advisor in Venezuela in 1995 and 1996, that's what I recommended. And I wrote a book about it. It's published in Caracas, and unfortunately they didn't do the reform. So we've had one problem after another in the bolivar and inflation ever since. And now I've been recommending that they really just get rid of the bolivar and dollarize, as I did actually in Montenegro in 1999. We got rid of the hyperinflating Yugoslav dinar, actually Serbian dinar at the time, and replaced it with the German mark. And in Ecuador in 2000, we got rid of the sucre and replaced it with the U.S. dollar. So that kind of thing should occur. That would smash the inflation, establish stability, and then you could move on with other kinds of reforms, and the place might look more attractive than it looks now.
Yeah, and it seems like it's the perfect time to do it, blow it all up, and then try and rebuild it with a strong currency. Especially when you're an oil exporter, you do have hard currencies coming in when it's not sanctioned.
Absolutely. So I think dollarization in Venezuela is first order of business. Forget about talking about the oil and everything. It's never going to happen until you stabilize the economy and reduce the currency risk and get the inflation out of the picture. How can you have an attractive country when you have inflation that's 863% per year? There's no way.
Yeah, it sounds like the only way that companies would do it is if they had military backed or US backed investments, which is seems like what they may be doing. But is there any other trends that you're watching out for 2026 that you think we could see?
Well, the two biggest economies, I already told you, I think the biggest problem facing the United States will be the fact that the inflation genie won't be back in the bottle, and people will continue to complain about affordability. And by the way, Trump has very low ratings on the economy. on the economic performance of the U.S. economy. He has very low ratings, and you've got midterm elections coming up, and if this continues, and if my thinking is correct that inflation genie will not be put back in the bottle, I think the Republicans will have a lot of trouble in the midterms. So that and because affordability will stay on everybody's radar. It's something that is associated with not being able to put the inflation genie back in the bottle. So that's one thing in the U.S. As far as China, the other huge economy in the world, their biggest problem is the opposite. It's deflation. The rate of growth in the money supply is below Hanke's golden growth rate, and they have deflation. They so they they have a nominal GDP target that 5% real plus 2% inflation, and they're never going to hit it. They're never going to hit 7%. That's my take on China, and it's in their case it's all about the money supply, the quantity theory of money.
Yep, that's what it's all about. So, Professor Hanke, thanks so much for coming back on the podcast. Really appreciate it. And my last question is, what is one message you want people to take away from the conversation?
I think the big message is they have to get their head around the quantity theory of money. Changes in the money supply with a lag affect asset prices, real economic activity, and inflation. It's all about money. How much fuel are you putting into the engine?
Yep, great message and very important. So, Professor Hanke, thanks so much. If anyone wanted to find out more about your work and what you do, where would the best place for that be?
They can follow me on X at Steve_Hanke, and we're running now. I have 818,500 followers the last time I looked this morning, and they can follow, by the way, those inflation readings and Venezuela and Iran. I'm putting those up every day so you can see what's happening. I'm measuring those inflations in all countries that I'm measuring with very high frequency data and measuring it very accurately.
Yeah, great. I'll put that on the description below, but thanks again for your time.
Thank you, Anthony. Great to be with you, and Happy New Year.
Hey, everyone. Thank you for listening. I really appreciate the support. If you've got value out of this, I'd really appreciate it if you could like, subscribe, or comment, good or bad feedback. I'm always open to that. But it really helps with the channel. As I said before, only about 14% of people actually subscribe to this channel. So if you were to that, it would really help. It could mean we could continue to grow. If not, thanks for watching, and see you on the next show. And you also might like this video right here. All right, thanks again.